The world's central banks are quietly doing something they've never done before. Not loudly, not dramatically, just steadily month after month for the last 5 years. They're selling dollars, not because the dollar crashed. Not because America went bankrupt, but because for the first time in 80 years, the people holding the most dollars are starting to ask a question they never used to ask. What if this doesn't last forever? In the year 2000, central banks around the world held 70% of their reserves in US dollars. Today, that number is 58%. That might sound like a boring slide in a pie chart. It's not. It's a slow-motion earthquake in the architecture of global power. And if you hold dollars, which you almost certainly do, this affects you more than you think. Set up why this matters now. Let's start with why you should care. Every time you buy something online from another country, every time oil gets pumped out of the ground in Saudi Arabia, every time a Korean company pays a German supplier, the transaction doesn't happen in won or euros. It happens in dollars. The US dollar isn't just America's currency. It's the world's currency. It's the language of global trade, and that gives the United States something no other country has. The ability to print money that the entire world needs. Think about that for a sec. If you're Thailand and you need to buy oil, you can't pay in baht. You need dollars. If you're Argentina and you want to borrow money internationally, you borrow in dollars. The demand for dollars isn't just domestic, it's global, which means the US can run deficits that would destroy any other country because there's always someone somewhere who needs more dollars. This arrangement has a name. It's called the dollar reserve system, and it's been the foundation of American power since World War II. But something is shifting. Here's how the reserve system works and why it's so important. After World War II, most of the world's economies were shattered. Europe was rubble. Japan was occupied. The only major economy left standing was the United States. So in 1944, representatives from 44 countries met in Bretton Woods, New Hampshire, and made a deal. The deal was simple. The US dollar would be pegged to gold at $35 an ounce. Every other currency would be pegged to the dollar. If you held dollars, you could theoretically exchange them for gold. And because the US had the largest gold reserves and the strongest economy, everyone agreed. The dollar was as good as gold, except it wasn't. By the early 1970s, the US had printed way more dollars than it had gold to back them. Other countries started getting nervous. France literally sent a warship to New York to pick up its gold. And in 1971, Richard Nixon did something remarkable. He ended the gold standard, just walked away from it. He went on TV and said, essentially, dollars are no longer convertible to gold. The dollar is now backed by nothing except trust in the United States. And here's the wild part. The system didn't collapse. It got stronger. Why? Because oil. In the years after Nixon closed the gold window, the US made a series of deals with Saudi Arabia and other OPEC countries. The deal was this: you sell oil in dollars and only dollars, and we'll provide military protection and buy your government bond. Suddenly, every country on Earth needed dollars not just for trade, but for energy. This was the birth of the petrodollar, and it locked in dollar dominance for the next 50 years. If you needed oil, you needed dollars. If you needed dollars, you bought US Treasury bonds. Those Treasury purchases funded US government spending, which allowed America to run massive deficits without triggering inflation or currency collapse. The whole world was essentially lending money to the US at low interest rates because they had no choice. It was an incredible deal for the United States. But every system has a limit, and the limit is trust. Here's the uncomfortable math. In 2000, central banks held about $9 trillion in dollar reserves. Today, they hold about $5 trillion. So in absolute terms, there are more dollars in reserve than ever before. But as a percentage of total reserves, the dollar has dropped from 70% to 58%. That 12 percentage point slide represents roughly $2 trillion that went into other currencies. Euros, yen, yuan, gold, even smaller currencies that nobody used to hold as reserves. What changed? 3 things. First, the US started using the dollar as a weapon. After Russia invaded Ukraine in 2022, the US and Europe froze $300 billion of Russian central bank reserves. That money was just gone. Russia couldn't access it, and every other country with dollar reserves looked at that and thought, if we ever get on the wrong side of Washington, they can do that to us too. China noticed, India noticed, Brazil noticed. They didn't say much publicly, but they started diversifying. Second, the US government debt exploded. In 2000, US federal debt was about $5 trillion. Today it's $36 trillion. The Congressional Budget Office projects it'll hit $50 trillion by 2034. At some point, the question stops being, will the US pay it back, and starts being, can the US pay it back? When you hold dollars, you're essentially holding US debt, and if that debt looks unsustainable, holding dollars looks riskier. Third, alternatives started emerging. For decades, there was no real alternative to the dollar. The euro was too fragmented, the yen was too small, the yuan wasn't convertible, but that's changing. China has been slowly opening its currency market. The euro has matured. Digital payment systems are making it easier to trade in non-dollar currencies. The infrastructure for a post-dollar world is being built quietly in the background. None of these things alone would break the dollar's dominance. But together they create something new, optionality. For the first time in generations, central banks have options, and they're using. Now let's be clear about what this is and what it isn't. This is not the sudden collapse of the dollar. The dollar is still the dominant reserve currency by a massive margin. 58% is still more than double the next closest currency. Every prediction of the dollar's imminent death over the last 20 years has been wrong, but this is also not nothing. The shift from 70% to 58% took about 2 decades. That's slow, but it's also steady, and the trend isn't reversing. If anything, it's accelerating. Central banks added more gold to their reserves in 2022 and 2023 than in any year since 1950. That's not random. That's a strategy. There's a narrative you'll hear in some corners of the internet that says the dollar is about to hyperinflate, that we're on the verge of Weimar Germany, that you need to buy gold and Bitcoin immediately or you'll lose everything. That's not what's happening. What's happening is more subtle and, in some ways, more important. The world isn't rejecting the dollar. It's just starting to treat it the way it treats everything else, with conditional trust instead of blind faith. Think of it like this. For decades, the dollar was the only game in town. If you wanted to play global economics, you played in dollars. Now, imagine you're a central bank in India or Brazil or Saudi Arabia. You still need dollars. But you don't need only dollars. You can hold 50% in dollars, 20% in euros, 15% in yuan, 10% in gold, 5% in other assets. You're not abandoning the dollar, you're hedging. And when every central bank in the world starts hedging at the same time, the math changes. So what does this mean for the United States? Historically, dollar dominance gave the US what economists call exorbitant privilege. The ability to borrow cheaply, the ability to run deficits without immediate consequences, the ability to sanction other countries by cutting them off from the dollar system. If that privilege erodes, even slowly, the consequences are real. Interest rates on US debt could rise. That means the government has to spend more money just to service the debt, which means less money for everything else. It means inflation could become harder to control. It means the US might actually have to balance its budget, which it hasn't seriously done in decades. It also means the US loses leverage. Right now, if the US wants to pressure another country, it can threaten dollar access. If alternatives exist, that threat carries less weight. But here's where it gets interesting. The US might not mind losing some of this privilege. Here's why. Dollar dominance comes with costs. When the whole world wants dollars, the dollar stays strong. A strong dollar makes US exports expensive and imports cheap. That's great for consumers, but terrible for manufacturers. It's one reason why American manufacturing has struggled for decades. A weaker dollar might actually help rebalance the US economy. The problem is, you can't engineer a slow, controlled decline in reserve status. It either happens or it doesn't, and if it happens too fast, it's a crisis. If it happens too slow, you don't get the benefits. The US is in a strange position. It built a system that gave it unparalleled power, and now that system is slowly unwinding, and there's no clear way to manage the transition. So what does this mean for you? If you're American, a weaker dollar could mean higher prices on imported goods. That's most consumer electronics, a lot of clothing, many cars. It could also mean higher interest rates if the US has to pay more to attract buyers for its debt. But it could mean better job prospects in manufacturing and exports. If you're not American, it could mean more options. Your country might be able to borrow in its own currency. Trade might become less dependent on access to US banks. You might have more negotiating power with the US, but it also means more instability. The dollar system, for all its flaws, provided a kind of predictability. Everyone knew the rules. A multipolar currency world is messier. Exchange rates fluctuate more, trade becomes more complicated, risk increases. Nobody wins cleanly in this transition. It's not a zero-sum game where China wins and America loses. It's a reshuffling of the entire deck. Here's what we know. The dollar is still the world's reserve currency, but its share of global reserves has dropped from 70% to 58% in 2 decades. Central banks are diversifying not because the dollar failed, but because they finally can. This isn't a crisis. It's a shift, but shifts have consequences. The United States built a system that gave it extraordinary power for 80 years. That system is starting to crack, not from external attack, but from its own internal contradictions. You can't run unlimited deficits forever. You can't weaponize the currency without others looking for alternatives. You can't expect unconditional trust when trust, like everything else, is a market. And maybe the strangest part of all this is that it's happening in slow motion. No dramatic collapse, no Lehman moment. Just a steady, quiet migration away from the thing that used to be inevitable. Central banks are still buying dollars, they're just not buying only dollars. And once that shift starts, it's very hard to reverse. So here's the question nobody can answer yet. What does the world look like when the dollar is no longer the only option? When America is still powerful, but not uniquely powerful? When the global financial system has to operate without a single anchor? We're about to find out whether we're ready or not.